All right, everybody, check, radio check. I want to welcome everybody. So today's topic is going to be about, what's going on in the market. It's all over the news. There's a lot of changes coming. Commodities, which is heavily oil laden, was positive for the month of May. And then you can see green, that's euro. So that's typically developed countries in Europe. And that also had a small gain. Most of the other indices were just about even for the month. And then real estate has started to take a correction, and you will see that. I've said in the past, I will continue to say that 1 month does not a market make. So as we look at the next month, right, or I'm sorry, year to date, we can see a little difference here, right? We can see that most of you know when you look at your statements, when you look at your 401k, when you look at your TSP, your 403b, they're probably all down, and that's reality, right? So depending on what investments your firm offers, most things across the boards. And we break things down again into equities, right, which are typically growth or value oriented, or income, which are typically bond oriented. The one thing that has been doing well is the commodity sector. And again, because it's so heavily oil laden, it's had a positive year. But if you recall 2 years ago, right, that it was down 30 or 40%. So, this is an area, a sector that is getting all the attention right now. And we're all feeling it at the pump, right, when we go to fill up our trucks or our cars. But everything else, if we look at right here, is the Dow Jones is down 9%. Again, developed countries is the light green or neon green, right? This is developed Europe. Pink is what I refer to as China, right? So that's down negative 12%. Then we have, I think, the purple here, they changed the colors on me. Yeah, this is small caps. So these are small companies in the US, and, they're getting beaten up here. And then I'm looking at the S&P, it's a purple. So that's the 13, right under the value stocks in the S&P 500. They were saying it's down 20% since the beginning of the year. So if you're looking at these indices, you can see that there's correlated that, everything within the equity markets is down. And then we're going to see on the next chart, right, that there are three indicators, right? The first one is the RSI relative strength index. And I just had compliance put in the red line because I knew we had crossed over, and I've been talking about it for the last few months. And so a red line in the past has meant that there's a bear coming, and we just entered into bear territory right now. So what does that mean? And the answer is, I don't know. There's conflicting data, right? So when COVID hit and we turned around and we said, oh my God, the sky is falling, we were able to, say, hey, look, but it looked like it was going to make a V, that it was going to pop back up. Well, now it's looking like it may very well not rebound as quickly. If it does rebound, it might be more of a U shape. You will see some of the high flyers. And remember, I've been saying for a couple of years now that a lot of the indices were the alphabet, right? Your Facebooks, your Netflix, your Googles, a lot of the technology sector, and these larger corporations were putting pressure. They were keeping the stock market afloat, but they were also now some of the first to start to lose value. So what does that mean, and what do I see? Or, in talking to Mark, and Chief Investment Officer at Brookstone, I'm going to show us a slide at the end, and then I'll give you my opinion. But right now, the data says, hey, look, we are in a downward trend. One of the things that I counsel is that, look, we do not experience a loss unless we sell. If we sell, we need to have a strategy not only to get out, but then the question is, where do we go, right? Or how do we get back in, and how long is this for? And all of which I don't know. There are things that we do, like I said, and you're going to see on the next slide, that are what we call bond alternatives, and we'll go from there. But the sky is not falling. Markets have been down before. A recession is looming. The storm clouds are there. All the indicators are there. We know that at the fuel pump, and the trickle down effects, we realize that. Everybody and their mother is talking about it, both between inflation and between supply shortages. There's some problems that need to get straightened out. But if you don't panic and you just think about this logically, you say, look, I don't need the money for X amount of years. I don't need the money for X amount of months. depending on your goals will determine what we can do and where we should be. Because again, if you sell right now, right, that we're going to turn around and realize that maybe people could be wrong, that you could turn around and just say, hey, good news, something happened, right? Maybe Russia backs out of Ukraine. Things could happen at the flip of the switch. And this is why I always caution, don't use emotions to make financial decisions. So now we're going to get into the income markets in May. And this has been my story for probably close to 8 years. It's just taken a little longer than I thought it was going to be. If you're in an income type portfolio, and think about it, that most of the advice that we get is that we should be allocated, and it's what we call asset allocation. So there should be a blend of equities, which we just looked at on the first screen, which are getting pressure, and income or more stable type vehicles. And the theory or the logic behind that is that income portion of the portfolios typically are safer, right, than equities or stocks or stock ownership. That's theory. But part of what is never usually discussed in this theory is that we've come off of a 30-year bull bond market. So a lot of you have heard me talk about this before, but if we've been slowly having the bond values depressed, right? Now as interest rates are rising, and just yesterday, one of the largest basis points increases in, I think it's almost 30 years from what I recall, right? So one of the largest increases, bonds do not like rising interest rates. So not only do we have our portfolios that are in equities under pressure because of, they have to figure out how to cut costs. Things are expensive, airline stocks, fuel, food, all the things that use petroleum, all these things that are more expensive. How do they do that? So we understand the equity side of the equation. I think that where people get sometimes a little confused is on the bond side of the equation, or the what I call here the income, is that, oh, that was supposed to be safe. I'm heading into retirement and I have this portfolio, and I've slowly started to dial my portfolio. In my working years, I was 60% equities, 40% income, bonds. And now as I get closer to retirement, let me put more and more money into bonds. So let's say it's a 50-50 or 60-40 of bonds to equities. That's the advice that typically is traditionally promoted. Well, the problem with that theory and that advice is that was in an environment where inflation rates were low, or money was cheap, or the cost of money. So we've come out of that. And as the government is starting to raise these interest rates in an effort to curb inflation, I was explaining this to somebody today, and hopefully this will make sense. Let's say you pay $1,000 for a bond. That's called par, right? Let's say that you're able to negotiate a 5% cost or rent or income from that bond. So you go, okay, that's paid twice a year, $25 every 6 months. But the part that most people don't understand is that $25 or that $50 that you're going to get, in order for you to get your $1,000 back, first it's based on the full faith and credit of the company you let the money to. So whether that be J&J, whether it be a municipality, whoever you lent the money to, because you're now a creditor, right? You've lent them the money. If you wait 30 years, if it's a 30-year bond, then you're guaranteed to get your $1,000 back. And that 5% or that rent of 5%, right, is your income. Well, if interest rates go up, and I'm somebody that goes, look, I can go over here and get 6% or 7% or 8% for my $1,000. Well, what happens is the person that's waiting the 30 years says, I don't want 5% anymore. I want 6%. So let me sell it. Let me go out to the market and offer it to somebody else. Well, I'm not going to pay $1,000 for something that I can buy that for the same $1,000 a higher interest rate. So therefore the bond has lost value. So that's the, sort of the Reader's Digest version of how bonds work. And understanding that will help you to say that, wow, having that risk in my portfolio, following traditional advice, can be problematic. So as we look here, and we're looking at the different types of bond holdings, right? So the gold here, and my eyes are bad. So these are high yield corporate bonds that paid the best. So let's just think about the sentence there, though. High yield, I've talked about it in the past. High yield is, in other words, let's just go ahead and replace high yield for the word jump. If we're going to get higher than above going rate for yield, I'm going to have to take higher risks. That means that the company that I lent the money to could be suspect or subject to not paying me back my $1,000. So, you see that most of these finish the month in okay, right? This isn't so bad. It's the next chart though, and this is the upsetting part, is that if you're living on a fixed income and you bought into the idea that, hey, listen, I'm just going to have an income portfolio, and if I can get 4 or 5% yield off my portfolio, well, look at these portfolios, incomes. I mean, they're down -7, -10, -13, -15, -21 for emerging markets. This is the risk that people face when they work at an employer and you're looking at your portfolio. And so the example that I gave on the previous slide of owning $1,000, that's if you own the bond. See, what most people don't understand is when you enter into a bond fund, you don't make any of those decisions to trade. So now what happens is you turn around and say, hey, I went through my statement that they gave me, the options for my 401ks, and I put in a blend, and I put in, they said 60-40. So I have some equities, I'm diversified. And now your bond portfolio, right, is now down. And it's just going to be very hard to recover. So I've talked about it in the past. I will continue to talk about. A lot of my clients, we've entered into what we call bond alternatives, right? What are bond alternatives? In my mind, there's 2 or 3 that you should think about. Typically, your 401k doesn't have, so don't even look at it. But whether it's with me or somebody, your financial advisor you're talking to, but the first is cash value life insurance. I'm a huge proponent of it, right? But that's, I'm not talking product here today. I just want you to understand, the sections of the tax code, 72E, 7702, I think they're very, very powerful. The second is, I got a client right now that was all ready to move forward, and table 10. So insurance is not an option for them. So now we look at an annuity, right? An annuity can offer us as a bond alternative. My clients that move money into annuities that had either very little fees or no fees have a 0% floor. That's indexing. We give up some of the gain on the upside, but we give up the risk on the downside. So it's another option. And the third is for a little bit more liquidity, semi-liquidity, or structured notes. I'm not going to get into it. I've talked to you about it in the past. If you want to learn more about it, I'm happy to share. But this is what our bond portfolio looks like. So we are continuing to decline. And I think that this will start to map out to be like a mountain, right? We will continue this downward spiral on bonds. So if you're in your bond portfolios, I'm not giving you any investment advice without looking at your portfolio, but think about it logically. If you sell today, you got a loss. That's absolute fact. Is it going to go up or down from here? I have no clue. But I would be very cautious of being overly exposed to bonds going forward. I hope I've made that message clear in the past. I will continue to preach that. Now that I've shared that data, let's look at what our recession probability analytics tool looks like. Now, I did not put the numbers on here, but last month they were at 31. The actual good news is last month it actually came back down. It went down to 29. It's probably going to go up this month now that I see everything going on. And it's not until it gets to 50 that, hey, things that we're now in a recession. So we haven't gotten there yet based on all the indicators. This is a proprietary tool that they use, that they developed, that basically takes 100 different factors from different, whether it be, housing sales, unemployment, inflation, all these factors, they put it in, and then they give it an algorithm and a number. And, when COVID hit, we got above 50, but then it dropped back down. It's been on an upward creep, but it's been pretty level. But I think we will continue to see drift up to the recession and probably cross over probably by third quarter this year. I think we might make it through the summer, but I think that that's coming. The last thing I wanted to share is Mark shared this slide. And if anybody wants this article, please email me. What does this chart say? Consumer sentiment. How does how does society, what's everybody feel right now? So what this chart is saying is, in the last 50 years, we're at the lowest we've ever been from a sentimental standpoint. And what they're saying is in the past, over the last 50 years, the average recovery of the S&P has been 24%. So my point is that right when you think emotionally you should get out is right when, that's what the other one they call that is a contrarian indicator. When everybody else is heading for the doors is when it's an opportunity to step in and start buying. I was listening to Dave Ramsey today, and I don't normally listen to him, but he did say something, right? Equities are on sale right now. And I absolutely concur, right? That is something on a go forward basis. The country is not crumbling. Sky's not falling. We're going to see a lot of red from now into the future. We're going to have to change our lifestyles to accommodate, rising gas prices, maybe figuring out, but you're going to start to see a lot of, I think, societal and ideological shifts, right? Where the government has been printing money in the past, it's been, I've been talking about this in the past, they can't continue to do that. People that were getting paid to stay home will not continue to do that. Our housing, our unemployment, where people were, I think, are able to work from home, will be the wave of the future. But we just have to just understand that when we're investing for our future, that we can't make emotional decisions, that you have to sort of make thoughtful and have thoughtful discussions with your advisor, figure out strategies. And then if there's going to be a change in a strategy, that's okay. Just make sure it's not based on an emotional decision, that it's made based on something thought out or change of goals or maybe lifestyle or some point in your life. So, I just wanted to get on again. I wanted to apologize for what happened a couple of weeks ago. Wanted to say, hey, exciting news that we were acquired by a larger corporation. I now technically get a paycheck now. So that's the first time in 20 years, right? So that was interesting. And I can tell you, when I signed up for the 401k, right, that I'm taking the free match, and then I'm putting my money into the Roth tax-free component. So I practice what I preach, because I do believe taxes in this country will go up. That's tax risk, and we will continue to talk about it. So building your basket of tax-free goods, I think, is important. So these are disclosures. Just talk about that says that everything I presented here is not my, I'm not, this is my opinion, right? So they have to disclose that. And, I try and just speak plainly. And then I hope everybody's doing well. I see some people I haven't seen on in a while. So hopefully you guys will join me in the future. And there's my number. And so a lot of you probably have my cell phone number. So call me. Don't be a stranger. And thank you very much. Stay safe. Have a great night.